Here we go, everybody. This is the Netflix 15-minute chart opening bell. Behind here, I have call contracts that were tradable. Netflix, here's the price print. It closed at 281.53, hit a low this morning of 251.46. And I did this live video last night with the entries and exits and trade management with MMTs. The call contract, which is a 255 call that was deep in the money, is losing $25. And that buying at the low on this opening bell candle right here, this 15-minute bar hits a bottom, and the stock comes right up to where we talked about going short, right below the 260. And the call went from the original low of 340 up to 835, and that was an entry and an exit, buying deflated premium in the calls. They made the high, they came down. So when we made the high here, we made the high there. Okay, the 250 call that was in the money, these call contracts hit the low of 590, but they made the high of that opening bell in this 15-minute bar from low to high. They hit 1186. They came down to 590, close to the 590 low right in here right now. And it's all based on how to buy deflated premium related to an earnings season. Okay? And what was the trade management going to be on the opening bell? And the opening bell was that the trade management was to short the equity at right below 260, as we did in pre-market. How many MMTs were involved in pre-market trade management this morning?
I certainly was. I
okay.
was.
How many? Okay. And so the trade management in the morning was that if we hit the left elbow gap down, that they would walk that up right below 260, and then it was time to make a short transaction. Is that true or false?
That is true.
That's correct.
So, is that correct, everyone?
Yes, sir.
Is that correct, Leo? Is that correct, Mr. Mantalk? How about you, David Beard? Okay. And what would that be like? And the call contracts got deflated, and then when they walked that price up to the high, it was to short the equity, sell the call, short the equity, but then to buy the 260 put. Because the 260 put and shorting the equity both, and selling out of the 255 call, and getting the low from the 250 call, selling those two transactions, and then on the reversal was to buy the low of the 260 put. So when we went up to 260, the low was $12 here, and when you're selling out of the call, 255 call, and you're selling out of the 250 call, and you're shorting this right below 260, you're buying the low over here. So what? Say you got in at 1220 or 1250. That's still a good entry. There was a $3.75 yield when Netflix reversed. And I can show it even on a 3-minute level here. That's Google. But I can show you on a 3-minute level of what Netflix did. It's going to be a little bit different. But you can see here on a 3-minute level, I'll go ahead and blow this up, MMTs. Okay? I didn't draw any teeny lines down there because they're very contracted, but it doesn't matter. The thing that matters is that when we made that high, we had that reversal here, and then we had the half bar, couldn't get above it, and we made the low. And when we made that low, when we made that high, the calls were being sold right out of the gate in that 3-minute bar. That all happened very quickly. And you would have had to have made that trade in probably about 1 minute. Bought the calls and sold them. Then buying the put and shorting the stock down, and then knowing when to come out down here is the right thing to do. Knowing when the consolidations are what they are, and knowing how Netflix trades. So let's take a look at this portion of the move. And you can see where the buy sides come in and how these options are changing. So when I'm breaking higher here, I'm still able to trade that 250 call in the money because it's Netflix is at 254 printing right here. And so these are in the money. This one over here, 255 now, is slightly not in the money. So the yield here versus the yield here are going to be different. Okay? And as Netflix tries to put in a bottom here on the opening bell, we will be watching the put option coming back. It's $1.50. It's over $2 off the high, because the reason why is this is ascending in value. And you can see the breakouts here to this reversal bar. This is half bar right there. So we can clearly see when that's breaking higher that the entry is better to be in the money here. This one's not going to give you as much yield because, like I said, Netflix is printing right now 250. Let's see where the bid is. Prints are going up here in the 254 area. So we know how to get these entries on the opening bell. These entries were great on the opening bell. And that the trade management scenario was set on how to buy deflated call premium when Netflix gapped down from its earnings. And then how do I buy that call intraday is when this is happening right here. And that the put option, when we have this breakout, 1575 is down to 1350. It's down $2. The put side is. And it's holding right now because we're getting a reversal. But when we were breaking out here, then we could have been buying the call and selling it. The in the money 250 call is going to get the best entry and exit and the best reward. The 255 call will come into play, but if we are reversing right here, then that means that this side of the market needs to be transacted. Now, there's a lot of emotion when it comes into regular options trading. People don't quite understand it. We do. It's wholesale versus retail. And the thing about it is, it's about the trade management. So when this is going to reverse, then of course this is going to hold its value, the 260 put, which is in the money now. It's in the money. So we're going to work on and define how to get that opening bell, big left elbow gap down, how to take all the premium out of the previous day contracts. And let's take a look at what those contracts were. So right here is the Netflix, and it's printing 254.11. So that 260 put is $6 in the money. We know it. The 250 call is $4 in the money, and we're going to get better premium intraday here. And it's a 729 weekly expiration. We know over here that the 255 call on a 729 expiration, and here's a 260 put that expires in August. This is the 260. And because it's a monthly expiration, the premiums are going to run different. Okay? So, by understanding what we see going on here on an intraday level is going to give us our trade management with big earnings. And this is already, waiting for the next day. The people that stayed long Netflix, they got killed. And we got to buy that premium for a trade and then walk away with the money. And the thing about it is, shorten that name up there at the highs, and everything that we did is understanding these shorts that go down in value, and we put the bottom in with that buy side is also going to be part of what side of the market am I buying over here. And when I get intraday breakouts, particularly on the opening bell, is the best trade there is. There is no better trade than the opening bell. So when they had them premiums down at the low, they walked them up to 1186 on that 250 call. But let's take a look at where the 250 call closed. It closed at $33, and we're buying down at the lows, and they ran them up to 11. And look at, that's how much premium they took out of those contracts, and we get to buy them wholesale as an operator on that morning bell, knowing the trade management and Netflix. There's a 255 call. That thing went up to 835 off of them lows. It's a $5 move. However, if you don't know how to trade the earnings volatility and understanding what's going on in here and what's going on there and what's going on to the short side of everything that goes on now, this whole move, I'll blow it up one more time. Right there, big left elbow gap down. He pops it, 260, and they short it down, just like I said. Now they're trying to build a bottom. At various times, when you know how to sell an option? How would you know to sell up here at the high? So you bought it, and how would you know how to get out? The minute that you reversed on that bar, you would be unloading the calls because they would come down in value, as they have, $4 off the high. Okay. Here, these are $3 and something off the high, because when that reversal starts to happen over here, you have to be selling here and here. Okay? And when the reversal goes down here, you have to be buying over here at the low. That's the opening print part. Now, the intraday part will be understanding how we're going to set that bottom up, and then are we going to break higher toward that 260 reversal over here. Okay? So we understand it, and we understand that it's a process. We understand that the training is very in-depth, because the training part is you've got to do, 100 of these throughout the year. And the more that you do it, and the more the mechanical part, the price action mechanical part of everything works in exchange models, it's going to take you through it. The more that you curb the emotion, more that you understand what's going on, why it's going to happen, who's behind it, so who's behind the equity side, who's behind the calls and the puts and the premium and the options market. All of these things are so valuable to learn that they're not taught the right way about the real true mechanics of the pricing control mechanisms that are going to happen, along with huge emotional responses, and how markets are made in all areas, and knowing when to be a seller on the highs here and here by understanding the shorter macro, that left elbow gap down. And we moved right off the high. Here, I'll blow this part of it up right here only. And you can clearly see that you popped up very quickly. 3, 6, then the reversal happened. So this was about a 5-minute opening bell transaction where they took the low and hit that high there at 835 on that 255. And they did it very quickly on the opening bell, where they took that right up to 1186. And it all happened so quick that that thunderbolt of emotion goes through people, and it keeps them out of the trade. They never do get it. They never do get in. Okay? Because it's happening so fast, and it creates such an emotional event that people lock up. They freeze. So they never do buy them wholesale. They don't understand the mechanics of what the value of it is and the trend management. So as we set up to make bottoms, we're going to really monitor it. There'll be several trades on Netflix for a long time to come. So the good news of it is understanding this bottom and how it's going to work, why it's going to do what it's going to do, and the trade management to calls and puts, along with the equity, going long with the equity, short with the equity, so that when you're shorting the equity here, you're also buying the 260 put over here at the lows and taking it up to 275. So you get that nice successful trade with the put, and you get to short Netflix 100 shares or whatever case is, 200, 500, whatever it is, and you're making money on the short, and you're making money on the put, and you sold the calls on the highs, because the calls lose their value when you go down short. So on the opening bell, understanding the mechanics of the opening bell along with earnings season and how to trade calls and puts and get the right entry is the key to success. The most important thing and the most rewarding thing is to understand how you get that thunderbolt of emotion on the opening and how it keeps you out of the market. Not just you, it keeps everyone out, because they don't know it. So they're not going to transact it. You have to know it. You have to understand the mechanics of option and equity and earnings. There's a whole lot of things in there that one needs to know in order to be able to make these transactions, and how they're going to happen very quickly in emotional earnings volatility. Emotional earnings volatility, and what is that going to look like before it happens? We got Amazon after the close tonight. Oh yeah, we're looking forward to it. And we'll do the same thing with Amazon as we're doing with this one. Yeah. Tomorrow morning with the options. Yeah. We sure will. Not only that, we'll enjoy it. But we'll be able to make that transaction right then because we know what the mechanics are, what the gimmicks are, what the manipulation is within the tape, how people drop bids, how they shake out buyers, how they walk bears on the short side very quickly. But most importantly, by not knowing it, it's extremely, extremely, extremely at a high risk level. And I don't recommend that people do it unless they have the right kind of training, because what happens is that volatility is going to hit you every single time, whether you like it or not. So with Amazon tomorrow morning, we'll be doing the same thing with Netflix. We'll be trading these intraday. We'll understand using the platform. It will tell us over here exactly what Netflix is going to do intraday, every day, just like it does before the earnings. Doesn't matter. This is a special on how to trade calls and puts and options emotional volatility within the price action, and how to make transactions on a left elbow and then a short and then a long, and how to manage the opening bell on emotional earnings and how they affect people, how the risk is high for people who don't know it, and why most of the people never ever get these moves, because they know that you're not going to be able to respond to it. They're going to make the money, and they did. And that's what it's about for them. Not a very fair playing field. However, they create the thunderbolt of emotion on that opening bell with that emotional earnings report, which keeps you totally out of it. They know what kind of mechanics that they're using in each one of these markets and how they're setting it up. They also know that the public won't make that transaction because they won't, out of fear.